Welcome back to the Daily Economy 24/7, where we break down the numbers that move the world. I'm your host, and today we're diving into one of the most important and most overlooked forces in the entire economy, the American consumer. For decades, consumer spending has powered roughly 70% of U.S. economic activity. When consumers are confident, the economy grows. When they pull back, everything slows. And right now, the signs are clear. The consumer is losing steam. Today, we're going deep into spending trends, debt stress, retail weakness, household psychology, and what a consumer slowdown means for the broader economy in 2026. Let's get into it. Let's start with the big picture. For the last few years, the American consumer has been surprisingly resilient. Even with inflation, even with higher interest rates, even with economic uncertainty, spending held up. But over the last several months, the tone has shifted. The data is showing clear signs of cooling. Retail sales have flattened or declined in key categories. Restaurant traffic is down. E-commerce growth has slowed. Travel spending is softening. Credit card balances are rising faster than incomes. Delinquencies are climbing. This isn't a collapse, it's a gradual weakening. But in economics, gradual shifts often matter more than sudden shocks. Why is this happening? 3 big reasons. 1. Inflation fatigue. Prices may not be rising as fast as before, but they're still high. Households feel squeezed. 2. Debt pressure. Credit card APRs are at record highs. Auto loans are expensive. Student loan payments are back. 3. Job market cooling. Unemployment is rising, hiring is slowing, and job security feels less certain. Consumers are adjusting, quietly, steadily, and meaningfully. And because consumer spending is such a large share of the economy, even a modest pullback can ripple outward. Let's zoom in on the sectors where the slowdown is most visible. Retail. Retail is one of the clearest indicators of consumer health. Clothing sales are down. Electronics are down. Home goods are down. Big box retailers are reporting weaker foot traffic. Discount stores are gaining share as households trade down. Consumers aren't stopping spending, they're spending differently. Restaurants and hospitality. Restaurant visits have declined for 3 straight months. Families are eating out less. People are choosing cheaper options. Tips are down. Higher-end dining is softening. Hospitality is also cooling after a strong post-pandemic rebound. Travel. Travel spending is still elevated compared to pre-pandemic levels, but momentum is slowing. Fewer bookings. Shorter trips. More price sensitivity. Lower demand for premium travel. Housing-related spending. When the housing market freezes, so does everything around it. Furniture. Appliances. Renovations. Home improvement projects. All of these categories are weakening. Autos. Auto sales are slowing as prices remain high. Loan rates remain painful. Delinquencies rise. The consumer slowdown is broad, and it's touching nearly every corner of the economy. Now let's talk about the human side, the household pressures driving this shift. 1. Inflation fatigue. Even if inflation is cooling, prices are still far above where they were a few years ago. Groceries. Utilities. Insurance. Rent. Healthcare. Childcare. These aren't optional expenses, They're unavoidable. Households feel like they're running on a treadmill that keeps speeding up. 2. Debt stress. Debt is becoming a major drag on spending. Credit card balances are at record highs. APRs are above 20%. Auto loan delinquencies are rising. Personal loan defaults are increasing. Student loan payments have resumed. When more income goes toward debt, less is available for discretionary spending. 3. Job security anxiety. The labor market is cooling. Fewer job openings. Longer hiring cycles. More selective employers. Rising unemployment. Even people who still have jobs feel less secure, and that changes behavior. 4. Savings depletion. The excess savings built up during the pandemic are largely gone. Households are now relying on credit, side gigs, reduced spending, budget tightening. This is the foundation of the consumer slowdown: stress, caution, and fatigue. Now let's talk policy, because the Federal Reserve is watching the consumer very closely. The Fed's challenge: inflation is still above target. The labor market is cooling. Consumers are slowing. Debt stress is rising. If the Fed cuts rates too soon, inflation could flare back up. If it waits too long, the consumer slowdown could deepen into a recession. This is the tightrope. Why the consumer matters so much. Consumer spending drives retail, housing, autos, services, travel, entertainment, small business revenue. When the consumer slows, the entire economy slows. The Fed's signals. Recently, the Fed has been softening its tone, acknowledging labor market cooling, preparing markets for potential cuts, emphasizing data dependence. But the timing is tricky. Cut too early, right-pointing arrow, inflation risk. Cut too late, right-pointing arrow, recession risk. The consumer slowdown puts enormous pressure on policymakers. Now let's look ahead, because the consumer slowdown could unfold in several ways. We'll walk through 3 scenarios. Scenario 1, mild slowdown. Scenario 2, significant pullback. Scenario 3, consumer recession. Each scenario has different implications for households, businesses, and policymakers. In this scenario, spending cools but doesn't collapse. Households cut back on discretionary items. Delay big purchases. Become more price sensitive. Businesses see slower revenue growth. Trim hiring. Offer more promotions and discounts. The Fed cuts rates gradually. Supports a soft landing. This is the best-case scenario, a controlled cooling. In this scenario, the slowdown becomes more pronounced. Households reduce restaurant visits. Cut travel. Delay home improvement. Buy fewer big-ticket items. Businesses reduce hours. Freeze hiring. Cut marketing and expansion. Lower earnings guidance. Markets become more volatile. Rotate into defensive sectors. The Fed faces pressure to cut faster. Balances inflation risk with recession risk. This scenario creates real economic drag. This is the scenario no one wants, but we need to understand it. Households pull back sharply. Prioritize essentials. Fall behind on debt. Reduce discretionary spending dramatically. Businesses. See revenue declines. Begin layoffs. Close underperforming locations. Cut investment. Markets. Price in recession. See earnings fall. Experience higher volatility. The Fed cuts aggressively. Deploys liquidity tools. Coordinates with fiscal policy. This is where a consumer slowdown becomes a broader economic downturn. So here's the bottom line. The American consumer has been the engine of the economy for decades, but that engine is starting to sputter. Inflation fatigue, debt stress, job market cooling, and rising uncertainty are all weighing on spending. A mild slowdown is manageable. A deeper pullback is concerning. A consumer recession would reshape the entire economic landscape. We'll continue tracking this story every day, right here on the Daily Economy 24/7. Stay informed, stay aware, and stay ahead.